The stock that's really broken the back of the market and the Bank Nifty is ICICI Bank. It's rare to see this kind of correction in ICICI Bank. Do you think the risk reward is now favorable, or is the market nervous about something that we don't have the data for right now?
Well, it's very hard to say if market is kind of perceiving any specific negative against ICICI Bank. Clearly, we don't have any data points suggesting the same. Our broad assessment with ICICI Bank is that things have started to improve for them. They've done reasonably well over the last 3 to 4 years on the liability side. They are almost at par with HDFC Bank and Axis Bank and State Bank of India on the liability side. The transition on the retail is broadly going on track. Currently, they have more than about 40% of the loan book on the retail side. The only stress point which continues to remain is on the corporate side. And our broad understanding appears to be that even here you've started to see some level of improvement. At least you should see it this year. So if there's any development which has happened in the last 1 month or 2 months with any specific corporate, that's going to be hard to say, because so far we have very little intelligence on it. But our broad assessment is for ICICI Bank, things seems to be on the mend, at least for them.
Okay. Mahesh, what's your general call on HDFC Bank cutting base rates by 35 basis points? And which are the banks which are most likely to follow suit in that amount of magnitude? Or do you think that HDFC Bank just stands out simply because only around 30 to 40% of their loan book is linked to the base rate, as opposed to the others, which is 70 to 80%?
Sure. I think HDFC Bank move of 35 basis points came in a bit of a surprise. Clearly, it is not that the direction is that big of a problem. I think if you look at almost all of our reports that we've been writing over the last 1 to 2 years' time, as interest rates starts to soften, you do expect banks to cut down base rates, broadly reflecting the change in the deposit rates that has happened out there. If you expect some of the other banks to follow by a similar quantum, it appears to be a little bit of a stretch at this stage. I think most of the other banks will follow suit, but probably by a slower quantum, and probably it will be a little bit delayed than what the current expectations are. But clearly, the broader impact of it is that, and if you look at the data points coming in from RBI, you do feel that growth is probably going to get delayed by another 1 or 2 years' time. Clearly, investment cycle is not picking up at the pace at which one initially expected, and that's kind of resulting in most of the banks cutting deposit rates, and following suit is the decline in base rates as well. So, broad direction appears to be okay. It's just that the quantum appears to be a bit high.
Okay, Mahesh, what about PSU banks? We had this rainbow rally in between, the whole Indradhanush scheme. And we saw the kind of rally in Bank of Baroda and SBI, but these stocks are now back to those lows. In fact, lower than at the point when the scheme was announced. At current prices, the big three, SBI, PNB, and BOB, are they good buys, or would you still avoid them?
See, as a sector, we've preferred the private sector banks over the public sector banks, and specifically within the public sector banks, we have favored SBI and Bank of Baroda over PNB. Our broad assessment is the same, and if you look at Project Indradhanush, it's actually a step in the right direction, in the sense that you are recapitalizing some of these banks, and you are kind of giving the right incentives to grow in the right areas, and which will be followed by further capital infusion over a period of time. I think the project per se is a good step from at least the government side. Now, between the three banks, I think our broad call has been more or less similar, and we are not going to change this on the back of the recent price correction which has happened. It is SBI followed by BOB and followed by PNB out there. Our call remains the same, that SBI stands out on the crowd for the same reason. A very strong liability franchise. They have the ability to move to the retail side. They're a lot more flexible on that front as compared to the other two banks. BOB, on the other hand, you're better off on that front, is that they have a slightly larger international book, which is reasonably insulated from the NPLs that the system is seeing from the domestic side. That's how you would position them at this stage. PNB is still quite a challenge for us to project the kind of impairment ratios and the trends on the impairment ratios over the next few quarters as well. And hence our broad thesis that SBI over BOB over PNB will be the direction of the call. The rest of the other PSU banks, it's a big challenge, because one of the biggest challenges with the PSU banks have is that they have a disproportionate amount of loan book on the corporate side. And if your broad assessment is that the investment cycle itself is going to take some time for recovery, clearly their top line growth is going to come under tremendous pressure, even if there is any kind of asset quality improvement as you head into the next couple of quarters. Over and above that, if there's been a change in the way base rate is being calculated, the biggest issue for the PSU pack comes on the top line side, and hence you're a lot more cautious on the PSUs over the private sector banks.
Okay. Mahesh, talking about the gross NPLs of the PSU banks, if I just take a look at what happened in Q1, IOB, for example, stood at 9.4%. We had United Bank still hovering at 9.5%, Bank of Maharashtra at 6.33%. Your sense in terms of, and these are only a few that I've named at this point, even PNB was at over 6%. In your sense, how much worse do you think that the gross NPLs on an absolute basis can get? And if not by this quarter, then by when and by how much?
Okay, so if you look at impairment ratio as a whole, and if you include the restructured book out there, our broad assessment is that we have probably peaked on that front. You should see improvements coming through. The biggest issue out there is on two accounts. One, obviously, that the growth is much lower, so the ratio appears to be much higher. But even if you exclude this mathematical part of it, you will see that slippages has started to see some level of peaking out for the sector as a whole. What appears to be a bigger challenge right now is that the recoveries is even weaker, and for that you would expect a much stronger economy to kind of support us stronger recoveries at this stage. So your broad, the way you look at it is that probably things have peaked out from a reporting perspective. You should see a large part of the impairment ratios kind of the movement happening within the impairment ratios, which is essentially from the restructured book to the gross NPA front. But headline ratio should be more or less stable from here onwards. If growth picks up much faster than what the current expectations are, you should see improvement in these numbers. But otherwise, I think we are more or less at the peak levels in terms of stress formations for the sector as a whole, which is including the public sector banks as well.
Okay. Coming back to the sector, Mahesh, what's your assessment in terms of what payment banks could throw up in terms of competition dynamics? Also, we are expected to hear from maybe the RBI on small bank licenses as well, and then eventually universal licenses on tap. How will the competition dynamics change according to you?
Well, on the recent announcement of payment banks, I think we would want to wait a little bit more, because the names which have come through are of entities who either have a very strong balance sheet or have access to a customer base out there. We still don't know how they are kind of building their business model to either reach that customer base or how much they are willing to spend to reach to that customer base out there. A large part of this is focused on the payment side, and one of the drawbacks which needs to be seen is that how much of them can access at that end of the market, which currently the public sector banks or the private sector banks are not focusing at this stage. So we would kind of look at it as a complement to the banking system at this stage, and not so much from a competing standpoint. What needs to be seen is the other one, which is essentially the finance banks, and at this stage we've still not seen the names out there. Once we see it, we'll probably take a fresh relook at some of these names. On the other question of universal banks and on-tap bank licenses, I think the broad point which you're making is very clear, that the system is going to get far more competitive. Add another layer that the regulations is kind of coming through, you know that things are going to be far challenging for the banking system over the next few years at least. So that doesn't change on how the business is going to come in, irrespective of whether the new banks are coming in or not. I think banks are going to become a lot more competitive in the next few years.
Okay. All right, Mahesh, we leave it on that note. Thanks very much for joining in and talking to us on a whole host of issues with regards to the banking space. Time for a break, but coming up.
India is actually shining in this gloom. It is a knee-jerk reaction that is forcing the market down. I think once sobriety returns, we'll probably be able to look at a magnifying glass and pick up some hidden gems, as you say.
Market veterans Ramesh Damani and Madhu Kela spoke to us earlier, and they shared their views on the market going forward. We'll get you a slice of that conversation on the other side of this break.
CNBC TV 18, celebrating 15 years of leadership.